Finance with Jordan. Today we'll be covering target stock using Peter Lynch's valuation model. For those of you who don't know Peter Lynch, he used to be a hedge fund manager who clocked in returns of 29.2% annually on average, and I think during the same time the S&P produced 14%, I think. But let's get into it. So we're talking about target stock today. Now, if you have a look, target stock, it's been quite bad, to be honest, for target stock for the past 5 years. And you can see it's down negative 34%. It seems to be at all-time lows at the moment at 99.24 was the last traded price. So we just want to work out if this is considered a buy or a hold or a sell. Now, if we look at Peter Lynch's valuation model, basically what it is it's EPS growth plus dividend divided by PE ratio. So let's get into it. So if you want to get information like that, good place to go is Yahoo Finance. So let's have a look. So you click on Yahoo Finance. You just want to go into the analysis tab there. And you have a bunch of data presented to you in the form of tables. So let's just have a look at revenue estimate. So currently they experience a bit of a decline. They're predicted to be in the negatives for the next year and then turns positive after that, 2.04%. If we have a look at their overall financials, it looks like, Target has been pretty stagnant from 2022. You can see they did 106 million, 109 million, 107, then back to 106, and then they've dropped off a bit to 105 in the trailing 12 months. So, yeah, it seems like growth seems to have stopped due to pressures from macroeconomic conditions. But let's go with a few assumptions, right? So for future EPS growth, I'm just going to put down for the next 5 years as 2%. For dividend yield, let's have a look at what Target's dividend yield is currently, which I think they have been increasing quite strongly. Let's have a look at their dividend. So 4.53%, as you can see there. So let's put that in, 4.53%, 4.53%. Let's have a look at their trailing 12-month PE ratio. PE ratio is right there, trailing 12-month, 11.57. Okay, so it looks like it is overvalued at this stage based on Peter Lynch's valuation model, with the assumptions that we've got that the EPS growth rate will be 2%, the dividend yield will stay at 4.53%, and the P ratio will be at, which is currently at 11.57. Let's just tweak this. So that can be our base scenario. If we go aggressive, it's still overvalued based on a 4% EPS growth according to Peter Lynch's valuation model. If we do a more conservative estimate, if we say they're going to be stagnant for the next 5 years, it's considered extremely overvalued by Peter Lynch's model. So that's what we think of target stock. Let me know how you guys find it. And if you have any other stocks you'd like me to cover, please reach out in the comments and we'll see if we can get to it. Thanks, everyone.